In this video, I'm going to tell you what market cap means in stocks. You've probably noticed this number before when you've searched for a stock quote, because typically when you look up a stock quote, somewhere nearby, you're going to see market cap. Understanding market cap is actually the very first lesson that I teach to new stock investors, so you're in the right place. And if you stay until the end of this video, I'm going to also tell you the next most important lesson that I always teach right after. So, let's get right into it. Hey everyone, I'm Richard Hopkins and welcome to another video. If you're new here and you want to learn how to invest in stocks successfully and reach financial freedom sooner, then start now by hitting subscribe and ringing the bell so you don't miss anything. Market cap is just a fancy way of saying the price tag on the entire company. Let me explain. And first, notice how I said the price tag and not the value of the company. That's important. Remember that for later, okay? Let's get a little deeper now. Market cap, aka market capitalization, is equal to the price per share of the stock multiplied by the number of shares outstanding. The easiest way to explain this is by showing you this table. Company A has a price per share of 50 cents and number of shares outstanding of 200 million. 50 cents per share times 200 million shares equals a market cap of $100 million. Company B has a price per share of $6.25 and number of shares outstanding of 16 million equals a market cap of 100 million. Company C has a price per share of $40 and number of shares outstanding of 2.5 million equals a market cap of 100 million. Company D has a price per share of $1,600 and number of shares outstanding 62,500 equals a market cap of $100 million. All of these companies are being priced by the market at $100 million, yet have a vastly different number of shares outstanding and therefore also a vastly different price per share. This means that the price per share on its own is completely irrelevant. Now let's look at some real-life examples of companies you'll actually recognize. At the time of me recording this, Apple has a price per share of $459.63 and number of shares outstanding of 4.276 billion. $459.63 per share times 4.276 billion shares equals a market cap of $1.965 trillion. Amazon has a price per share of $3,148.02 and number of shares outstanding of 500.89 million equals a market cap of $1.576 trillion. Facebook has a price per share of $261.24 and number of shares outstanding of 2.849 billion equals a market cap of $744 billion. Berkshire Hathaway has a price per share of $316,251 and number of shares outstanding of 1.592 million equals a market cap of $503 billion. So what can we learn from this table? Mostly that the price per share is kind of irrelevant and that public companies can have a wide varying number of shares outstanding. So if you were only looking at the price per share with no other information, then you wouldn't really be able to get very far. Meaning, say somebody asked you, hey, what company costs more? Company A trading for 50 cents per share or Company B trading for $6.25 per share? The answer is that it's a trick question. You don't have enough information. You need to know the number of shares outstanding. So what is this shares outstanding that we keep talking about? Shares outstanding means the number of shares the company's ownership has been divided up into. Shares of stock represent an ownership interest in a company. So if you own 1% of the total number of shares outstanding, you own 1% of that company. If you own 10% of the total number of shares outstanding, you own 10% of the company. During market hours, if you've ever pulled up a stock quote on your phone or on the computer, you've probably noticed how the share price is always moving up and down every second or maybe every few minutes for the less traded stocks. So technically, market cap is moving up and down right along with it. However, most websites and apps will only update that market cap figure once per day based on the previous day's closing price rather than having it constantly moving up and down right alongside the price per share. Another thing, the number of shares outstanding can also change. For example, number of shares outstanding will increase when a company decides to issue new shares. Companies do this as a way of raising money without taking on debt. Number of shares outstanding will decrease when a company decides to buy back shares. Companies do this as a way of returning value to shareholders because your percentage of ownership increases as the total number of shares decreases. I'll show you what I mean using the companies we already just talked about earlier. So here's a chart of the number of shares outstanding for Apple. As you can see, in the earlier growth years of the company, they were issuing new shares to raise money and therefore increasing the shares outstanding. Now, in more recent years, as a more mature company, they've begun buying back stock quite heavily. Here's Amazon shares outstanding. You'll notice that although shares outstanding have decreased over some short periods, for the most part, shares outstanding have just been increasing. Again, when shares outstanding increase, that's the company issuing shares as a way of raising capital. This is a way for the company to get more money to continue to grow without having to take on debt. Here's Facebook. A little bit less history for this one, but you can see some share issuing in the past, and then mostly level over the past few years with just a little bit of share repurchasing. And here's the last one. This one's Berkshire Hathaway. The main interesting thing to notice here is how Berkshire Hathaway has started buying back shares in the past year or so. Another way that shares outstanding can change is when a company does a stock split. A recent example of that is Apple. Apple announced that they would do a 4-for-1 stock split on August 31st, 2020. I'm filming this video in August before the 31st, so the stock split hasn't happened yet. However, on that date, Apple shareholders will find that they have 4 times the number of shares in their accounts and that the price per share will be 1/4 of what it was the day before. This is the 5th stock split Apple has done. In 1987, they did a 2-for-1 stock split. In 2000, they did another 2-for-1 stock split. In 2005, another 2-for-1 stock split. And in 2014, they did a 7-for-1 stock split. You can think of stock splits as if you bought a pizza with 3 of your friends and you each own 1/4 of the pizza. Say the pizza is delivered and it's been split up into 4 equal slices. You own one of those 4 quarters of pizza. But now let's say you and your friends decide to split up the pizza into 8 equal slices instead. You'll now own 2/8 of the pizza. So you still own the same amount of pizza. It works the same way with stock splits. The reason a company would do a stock split is just because they'd like the price per share to be lower so that buying shares is more accessible to the smaller investor. That's it. It doesn't change the fundamentals of the business at all. So here's the next and most important lesson. Remember at the very beginning of this video when I told you that market cap is the price tag and not the value of the entire company? This is what the successful investor thinks about. Listen, before you buy shares of a company, you have to actually just forget about the share price altogether. Instead, think of the entire company as a whole and ask yourself questions like, how much profit does this company make? And how much profit will the company make in the future? And ask yourself, if I were to buy this entire company, how much would I be willing to pay? What would it be worth if you were going to buy 100% of this company? And then, after you have a value in mind, then go look at the market cap. If what you think it's worth is higher, or at least the same as the market cap, aka the price tag, then it might be a good investment. On the other hand, if your estimate of what it's worth turns out to be much lower than the current market cap, then you should probably give it a pass for now and wait for it to be trading at a more sensible price in the future. And just move on and find another company. So always remember, if you're looking at just the price per share when making an investment decision, then you might as well just go to the casino instead. Hey, don't forget to like this video, subscribe, and ring the bell. I'm going to be talking more in depth in future videos about how to value companies and look at different companies I'm buying as well. So make sure you subscribe and ring that bell so you don't miss any of that. I also made this next video for you right over here that I think you're going to get a lot of value out of. So if you want to keep learning, click this video next and I'll see you over there.